Welcome back to educator.com. In today's lecture, we're going to go over saving, investment, and the financial system. In today's lesson overview, what we're going to do is we're going to learn the relationship between saving and investment spending. There's actually a very direct relationship, very easy to follow, so we'll go step by step. So if you're not sure how saving can actually translate into investment, you'll make sure to see the connection. We're going to differentiate between national versus private savings, simple equation here. We're going to review the purpose of the four principal types of financial assets. There's stocks, bonds, loans, and bank deposits. So again, there's four different types of, financial assets. Obviously, there's all these different types of assets you can own, but for the most part, you can categorize financial assets into one of these four categories. Stocks, bonds, loans, and bank deposits. And then finally, we're going to establish how different financial intermediaries help investors achieve diversification. And the four financial intermediaries are going to be banks, mutual funds, life insurance, and pension funds. In this course in macroeconomics, the functions of banks is probably going to be the most predominant financial intermediary we're going to look at, but doesn't hurt to look at these different things. So an understanding of how our financial system works and savings, a lot of it might not be directly tested on the AP Macro exam, but having a solid understanding when you're dealing with loanable funds and the concept of understanding this is pretty essential if you want to get that 5 on the AP Macro exam. All right, so saving and investment spending identity. So ultimately, we're going to get to basically prove a little mini proof. We don't do a whole lot of proofs in economics, but we're going to basically prove how savings and investment is always going to equal each other. So that's basically an accounting fact here. So savings, investment, spending identity is such that a fact of accounting is that they are always equal for the economy as a whole. Now again, individually, one person's saving might not be someone else's investing, but if you look at the entire economy as a whole, whatever the country saves is also going to be what a country invests, because that's basically, they're going to end up equaling each other. So let's imagine a very simple country. Imagine a country with no government and no trade. So if you want to harken back to the macroeconomics equation, you might want to go back to that here. And so y equals c plus I plus g plus nx. Now here's the problem. There's, in this, again, simplified economy, there's no government and there's no trade. So we can just cancel out the nx and we cancel out the g. So basically, to rewrite this equation here, y equals c plus I. And so if you look at it from that perspective, then it becomes a lot more simple, and then we can set savings to investment. So total income equals total spending. So that's going to be something that, if you recall the circular flow diagram, the amount of money that's spent in the economy is going to be someone else's income. And so that's basically, when you're dealing with the circular flow diagram, that's the assumption that's being made. That someone else's income is going to end up being someone else's expenditures. And again, there's three different ways to calculate the gross domestic product. There's the value-added approach, the GDP, the final goods and services approach, and also the factor income approach. And again, aside from some statistical discrepancy, they're going to equal each other. And so total income equals total spending. Now, total income, again, if you take a look at it, total income actually equals consumer spending plus savings. So recall the marginal propensity to consume. You get a certain amount of money, and consumers are going to either spend it or save it. So the MPC plus MPS is going to equal 1. So a percentage of your money you spend and percentage that you save, right? Now, if you look at just spending here, total spending is going to equal consumer expenditures plus investment spending, which is what we did right here. So I broke it down a little bit, y equals c plus I plus g plus nx, but with no government and no exports or imports, we break the macroeconomics equation down to a simpler equation, y equals c plus I. Well, let's look at the transitive property right here. So the transitive property, if you're not too comfortable with some mathematical properties. The transitive property states that if A equals B and B equals C, then A equals C. That being the case, therefore, consumer spending plus savings, and let's label that as being A. Consumer spending plus savings, that's A. Okay, equals consumer spending plus investment spending. The reason why is that if A, in this case here, consumer spending plus consumer spending plus consumer savings, if that equals total income, and total income equals B, and we know that total spending equals total income, then we can just basically substitute it as being, consumer spending plus savings equals total savings or total spending. And basically, you also get the equation where total spending is consumer spending plus investment spending. So you have consumer spending plus savings equals consumer spending plus investment savings, or investment spending. Now, how do you simplify this equation? Well, you see the consumer spending and the investment spending, they're the ones that are going to be, in the case, they're the only unique items. Or consumer spending, they're going to cancel each other out because they're on both sides of the equation. So the unique items in both these equations is going to be savings right here and investment spending. So if you just cross out consumer spending here, so take that out here, you subtract consumer spending on both sides, you end up with this savings investment spending identity, which savings equals investment spending. So again, from an intuitive level, this should make some sense. If you save $20,000 for a vacation, a really nice vacation around the world, if you save that initially, well, that money that you save in a bank or whatever financial intermediary is going to be invested and it's going to be made somewhere else. So the more that an individual saves, then the more investment ability is going to be generated, because long run growth is going to come from investment, and we get the investment from the savings. So let's take a look at budget surplus and deficit. So we looked at consumer spending and investment spending. So we looked at consumer expenditures and business investment, but sometimes the government will save, and I put that in quotation marks. Now, government they're not really saving any money or dissaving, so to speak, but let's assume that governments can actually have the ability to save money. So government will save money, and in others, it will spend more than its revenue collected in taxes. So basic terminology is know the difference between a budget surplus versus a budget deficit. Now, what's a budget surplus? Now, again, if you're watching this in the United States, chances are the country hasn't been in a budget surplus situation in quite a long time. If you can recall, back in the election of 2000, one of the questions that presidential candidates at the time, which was Al Gore and George W. Bush, and as we all know, George W. Bush won the presidency that year. One of the questions that was posed in the debate was, what would you do with all the surplus that's coming? So in the late 1990s, under the Clinton administration, one of the problems that was created was the amount of surplus that was coming into the U.S. government. Again, compared to what's going on today, where you have trillions of dollars in deficit, or at least hundreds of billions of dollars, that was kind of a time that's kind of long gone. The idea that the government's actually taking more tax revenue than they're spending. So the idea of what a budget surplus is, and again hasn't occurred in quite some time, occurs when government revenues exceed government spending. So again, to put it in equality format here, government revenues. Now, revenue meaning any form of taxes or payments to the government, that's going to be greater than the government spending. So all the money spent for the military, all the money for different ideas. Now, here's depending on your form of accounting. So this would be the explicit spending that the government spends on. Now, if you include some implicit liabilities, such as the amount that was owed in terms of unfunded liabilities for future pension obligations, you can argue that we were even in a budget deficit during the times of official budget surplus. But let's ignore the unfunded liabilities because that's not specifically on the books. But clearly, if you looked at the trend, you can kind of see the future problems with that. Budget deficit, again, this is something that if you're watching this and you're preparing for the AP exam, most of the governments, at least in the United States, it seems like year after year you have budget deficit after budget deficit. So this occurs when the government spending exceeds government revenue. And I didn't coincidentally use this red marker here because you are in the red. You're in the red when you are spending more money that you have. So when the government spending is greater than the government revenue, then you have what's called a budget deficit. So again, these are the two basic situations that the government can have, a budget surplus or a budget deficit. Now, it can have a balanced budget in theory. Again, to get the income, the amount of money that's spent, when I say income, I mean taxes. The amount of taxes coming in to be exactly the amount of saving, it's very statistically unlikely. So in certain years, we'll have a large surplus, small surplus, large deficit, small deficit. And then when you combine that together, if you add up all the deficits and you add all the surpluses, the combined amount of deficits minus the surpluses, plus the interest and everything that's accrued, that will lead to what's called national debt. And again, if you keep on accruing deficits after deficits, which is what's been going on in the United States, then you get an ever-growing national debt. But a budget balance would be the difference between government spending and revenue. So it could be either a deficit or surplus. So rather than saying deficit or surplus, which you could do, if you just say the budget balance, that's an alternative way to refer to a surplus or a deficit. So if you take a look at that, then the national savings, the amount of money that's saved by the American people, can be kind of translated by private savings plus the budget balance. Now, what is the budget balance? In most years, it's going to be, at least in the United States, in the 21st century, it's usually going to be a negative amount. So let's say the private savings in the United States, for example, was $250 billion. And then hypothetically, if you had a budget deficit of $50 billion, again, I'm just throwing out random numbers, then you subtract $50 billion and your national savings is going to equal $200 billion. $200 billion. So in years where you have a budget deficit, your national savings is going to be less than your private savings. In a surplus year, again, hypothetically, let's say that's in the following year, let's say you have the exact same amount of private savings, but you have a budget surplus. Again, that sounds kind of something that may never happen again. I'm sure at some point in time it will in the United States. But let's say a budget surplus of $150 billion. Then what you have is national savings of $400 billion. So if you combine the business sector with the private savings that's accrued, and you combine that with the government savings that's accrued through a budget surplus. Okay, so capital inflows and capital outflows, that's going to change a little bit because we care about the amount saved as a country, but we also want to take a look at the cash inflow and outflow. So the best way I could try to describe this is, if you keep track of your personal finances, there's different ways that you can include income and expenses. And there's also ways that you can consider, cash flow. Well, capital inflow and outflows would be more like a cash flow statement, Whereas income and expenditures, if you're going to track your monthly budget, then you're going to track every time you spend money and every time you save money, or every time you spend money and every time you make money. What a cash flow statement does, it tracks all your cash transactions when money is flowing in and out. Again, kind of a subtle difference, but keep in mind there's a difference, because when you make an expense, there's not necessarily a cash flow coming in. So that's what I would liken capital inflows and outflows to, because with capital inflows and outflows, when money is coming in from a foreign nation, keep in mind that eventually that money is going to be paid back. So it's not really a form of savings, because in fact you're actually paying with a form of interest. But at the same time, money is coming in here. So that being said, countries receive inflows of funds and also generates outflows of funds. So basically, money is going out of the United States, money is coming into the United States, and then the difference would be referred to as the capital inflow, or the net inflow of funds into the country. So again, this kind of sets up, well, what does that actually mean here? So let's take a look at specifically in the United States with its capital inflows and outflows, and we're going to deal with some private savings and national savings as well. So in 2008, the United States had capital inflows totaling $707 billion. So again, this is a positive. If it was a negative, it would be that money is leaving net negative $707 billion. So what this means is other countries are finding the United States an attractive place to invest its money. And again, there's maybe some negatives from that, but there's certainly some positives as well. So again, meaning the U.S. is an attractive place to save money. I mean, again, when I say relatively attractive, it's $707 billion attractive. I mean, people aren't just going to throw their money into a place unless that's the best alternative, considering risk and return. Now, so if you take a look at that number here and combine this with some real investment spending here, let's assume that the total investment spending is $2,632 billion, or let's just say $2.632 trillion. And let's assume that the private savings is $2,506.9 billion, or $2.5 trillion. And let's assume that the budget deficit is $683 billion. At the same time, let's also include the idea that there are capital inflows, so net inflow of $707 billion. Now, again, keep in mind, the equation for national savings equals the private savings plus the budget balance. Now I put national savings equals private savings minus the budget deficit, because we've established that there's a budget deficit of $683 billion. So we'll just, you add the budget balance, but you're adding a negative. So let's just subtract the deficit here. So the national savings plus capital inflow here, that's going to include the amount of money that's also coming in, right? So you have the national savings, which is the private savings minus budget deficit. And you also have the budget or the inflow here. So if you take the national savings here, so you have the national savings is $1,823.9 billion. Now, how did I get that? Well, the private savings again was $2,506.9 billion, and the budget deficit was 683. So subtracted these two here, and when you subtract these two, you get the national savings. So yes, the private savings were fairly substantial, but you had a huge, again, depending on it's relative to a certain figure, but $683 billion is the budget deficit. So your national savings is only going to be $1,823 billion, or $1.8 trillion. And then you add the capital inflows of $707 billion, and you're going to get a total of $2,530.9 billion. Now again, there's a statistical discrepancy. If this is the total amount of savings, then theoretically, why is it the case that does not equal 2,632 billion? Because in theory, 2,632 billion, which is the investment spending, Okay, it really should equal 2,530.9 billion, and that's going to be the savings. Yeah, and the reason why that's not the case is that, again, you have a statistical discrepancy of $101.1 billion. So in theory, they're going to equal each other, but when you're dealing with real life issues, money not necessarily being accounted for properly, money being lost in the process, what's a little $101.1 billion? I mean, come on, that's pocket change for you and I, right? So again, for the most part, savings and investment are going to equal each other. So what are the tasks of this financial system? There are three major tasks, and so let's go over these three tasks and individually review them. First is to reduce transaction costs. Second is to reduce risk, and third is to provide liquidity. So what does that mean to do these different things? So companies, they're when they're in the process of trying to raise money, it would be logistically very cumbersome to go individually and raise capital from 1,000 different individuals signing different loan contracts. It'd be very burdensome to do that individually. So the goal of a financial system is that companies will get loans from banks or issue bonds to raise money rather than individually negotiate a particular contract. Again, to get a comparable amount from individuals would be logistically difficult, if not impossible. So banks reduce the opportunity cost. So the idea of banks making lending and borrowing a lot easier than performing all these individual contracts with loan obligations, accepting different forms of collateral, makes it a lot easier. Okay, another reason is that it reduces risk. So people have various levels of risk tolerance. So financial systems reduce risk through diversification. Sole ownership of a $1 billion company would be risky. Recent example within the past decade, Facebook went public. The CEO at the time of the IPO, the person who created Facebook, Mark Zuckerberg, and the board of directors, they decided to go public. So basically, a company that was worth X amount of dollars and a couple of billions, they decided to go public, and it made a lot of people at Facebook extremely rich. The reason why is those people that own Facebook, however many shares are out there, what they did is they sold the shares, and now a lot of the American public and a lot of people outside of the United States, they own Facebook stock, so they own the company. Now, if Mark Zuckerberg, in theory, if he never gave up any ownership control of his company, then he would own 100% of Facebook, but chances are he wouldn't have been able to expand to make it what it was at the time of the IPO or what it is today. So it's a very simple concept of by having financial intermediaries in place, the task of a financial system is to kind of spread out risk and diversify. So people would much rather not have 100% of their wealth tied up to a company, but rather have a good portion of their company through stocks, but selling shares of stocks for cash, which is a little bit more flexible as to what you can do. I don't know many people that go shopping, holding Facebook shares of stock in order to buy something. What they do is they sell that share, give that risk of ownership to someone else. In exchange, they get cash, and people want cash in exchange for most things. The last thing it does, it provides liquidity. So having access to cash, again, is critical. Liquid assets are generally preferred to illiquid assets. One of the questions I pose to my students to give them an idea of what liquidity means is that, given a choice between a $1 million house or $1 million in cash, what would you rather have? And pretty much without fail, a vast majority of the students will say $1 million in cash. And if I dig deeper as to why they wouldn't rather have the $1 million house, it has to do with flexibility and the ability to convert into cash. Well, if you have $1 million in cash, it's really easy to convert into cash. Now, that $1 million investment in real estate, if you're investing in the long run, maybe it might appreciate and it may be a better investment in the long run. But the idea that if you wanted to turn that $1 million house into cash immediately, you might have to wait 6 months on the market. If you want to sell it immediately, you might only get 90% of its value. So it's generally illiquid. So real estate tends to be illiquid, and what banks do, what these financial intermediaries do, is that they increase liquidity. They provide means for which to convert assets pretty much very quickly into cash. So let's take a look at these different types of financial assets. So three major ones that we're going to talk about here are bonds, loan-backed securities, and stocks. So what does it mean to have a bond? Bonds is very simple. It's an IOU issued by the borrower with a seller of the bond paying a fixed yearly interest and principal at the end of the term of the loan. So if I issue a bond, if I issue a Parks Place bond, and my term length is 5 years, and let's say the coupon rate is 10%, then if you buy the bond from me, you're lending me money. Okay, so if the length is 10 years or 5 years, and the interest rate or the coupon rate is 10%, and you loan me $10,000, then every year I'm going to give you a payment of $1,000 a year for 5 years, and at the end of the 5-year term, you get that you got that 5% interest, but you also get the principal back of $10,000. So that's basically the way that bonds work. One of my favorite shows on TV is Shark Tank, and one of the judges, or one of the sharks, usually maybe not the most well-liked shark, whereas a lot of the other sharks, they'll propose equity ownership, where one of the entrepreneurs asks for, let's say, $10,000 in exchange for 25% of the company, giving equity ownership. Mr. Wonderful, the shark, tends to prefer loan arrangements where it's basically a bond. Basically, you have this loan arrangement where he doesn't take any equity ownership, but basically it's the idea, as long as the business is solvent, as long as the business is generating money, then there's a payment. So he'll ask for, he'll give $100,000, but in exchange, rather than equity ownership, he wants to be paid back. Now, sometimes it's very creative loans, so a very creative, unique type of bond, particular to that show. But it's a loan, and that's basically what bonds are. So when you buy a bond, you don't have ownership in the company. You just are claiming rights for future payments, and you have more of a claim to the company's funds than someone who has stock ownership in the company. Now, the higher the default risk, the higher the interest rate. So right now, if you want to buy U.S. Treasury bonds, chances are you're going to be compensated with relatively low interest, simply because the U.S. Treasury, at least to the date of this filming, has never defaulted on any loan. So 100% repayment usually is going to be greeted with a fairly low interest rate. Loan-backed securities. So these are loans that are packaged together and sold as assets. So what banks will do is they'll combine a lot of different loans together, and basically they'll be sold as assets, because loans, again, they're seen as liabilities if you actually borrow the money. But if you're the bank and you lend out the money, if you package a bunch of loans together, say 100 different mortgage loans, what could go wrong? You have 100 different independent buyers or borrowers, and you package that together. Let's say you get 5% interest, you repackage that, and you sell it. It worked fine, except during the financial crisis of 2008, which happened in part because there's a high rate of mortgage-backed securities that defaulted. Again, that being said, are there still more mortgage-backed securities that are being traded? Yes, but now maybe there's a little bit more caution when you're dealing with mortgage-backed securities. When you have the whole housing market collapse, then what seemed like an independent event now is correlated together. So did we learn our lesson by staying away from these types of products? And the answer is probably not. Whether it's going to happen through mortgage-backed securities or some other creative financial product, there's different types of ways that can have unintended consequences. But that's not up to any individual to decide where or when the next bubble is, right? And finally, there's stock. So stock is a direct ownership in a company. Chances are, if you're watching this, chances are if you know anyone, if your parents, if your friends own stock, they actually own ownership in the company. So, for example, owning one share of Apple means that you own 1/900 millionth of the company. So if you own 900 million shares of Apple, you are an extremely rich person. Again, at the time of this filming here, you have Apple stock being $500 a share. Actually, yesterday, the earnings report, it was a little bit disappointing to investors, so it dropped like 8%, from $550 to $510. But again, if you're watching this, stock could have gone up, it could have gone down. And that's the thing about stocks. Stock works as a little bit more of a riskier financial asset. And within stocks, you can get risky stocks, you can get more conservative stocks, stocks that pay dividends, stocks that don't pay dividends. And you have a lot of different types of things that you can do with stocks. Stock derivatives, you can deal with put options, call options, a lot of different types of speculation. But for the most part, owning individual stocks, that would probably be the most common type of financial asset that individuals own. Again, it's through a variety of means, but stocks are one way to try to increase your returns on the money that you have. So what is a financial intermediary? Okay, so what a financial intermediary is are institutions that transforms funds gathered from many individuals into financial assets. So they're the ones that facilitate the process, right? Again, the most popular would probably be mutual funds. We'll talk a little about pension funds, life insurance companies, and banks. Okay, but again, to give you an idea that most individuals aren't individually gonna buy stocks, individually buy their own loans. In fact, about 75% of wealth in the United States is held through these four types of financial intermediaries, again, rather than directly through cash or individually trying to buy stocks through that. So, yeah, absolutely. In today's day and age, you can open up a brokerage account online with Fidelity, with Vanguard, with a lot of these different places. You can individually take ownership of financial assets, but I would say the majority of Americans are going to own a lot of these financial assets through financial intermediaries. Yeah. Now, what are some of these financial intermediaries? Again, probably by far the most popular form of retirement investing is going to be through mutual funds. And what are mutual funds exactly? They're financial intermediaries. They create a portfolio of stocks and or bonds, and then they sell shares to the individual investor. So you don't directly own any stock, but you own shares in the portfolio of different stocks. So instead of buying one share of Apple, you're buying 1/100th of Apple among many different stocks. So let's say in a portfolio, there's a total of $500 million worth of assets. And you are purchasing a share in whatever the portfolio has. So what that allows you to do, when you buy a mutual fund, you are individually not picking stocks. You are, buying one particular might be Waddell & Reed asset strategy, where the goal is to find undervalued stocks, or you might buy a Fidelity large cap stock, where you're just buying very large cap stocks in the domestic market. You can buy an emerging markets stock fund. You can buy a Asia Pacific bond fund. So there's all these different types of stocks that you can buy, but the key is that you're personally not picking these individual financial assets. You're actually going through an intermediary. You're going through the mutual fund. Clear major benefit would include diversification of investments rather than owning one single stock. So if you have one stock and that plummets, well, guess what? In the portfolio, you have many other stocks, maybe 20, 30, 40 stocks. You might have some bonds in there. So that one stock that plummets, while it will hurt you, it won't necessarily kill you. Now that's also the downside of mutual funds. Major downside would be the inability to hit a home run with a single stock. So imagine if you bought Netflix. I don't know, let's say in the year 2000. Don't know the specific price of the stock, but clearly in 2000, the major player in the video rental industry was Blockbuster. In fact, Netflix went to the head of Blockbuster and wanted to sell. You wanted to merge together, would give 49% share of the company to Blockbuster and then Blockbuster would acquire the rights to Netflix. Well, the Blockbuster CEO probably made a major goof by not accepting these terms. And if you were one of the few people that invested a lot of money in Netflix, if the stock went from, let's say it was $10, much later in 2010. I don't want to say 2008 or 2009 stocks were probably struggling back then, but it went as high as $300. So can you imagine investing, $10,000 and your stock goes up 300%? Okay, you would have you'd have 300 times your money. So a $10,000 investment would have yielded 10,000. And then again, you have 30 times growth here. Okay, you would have $300,000. If you invested $100,000, you'd have $3 million. So you have the inability. Now, again, the major benefit again is that, well, if you bought Netflix at that price when it was roughly $300 a share, so if it's $300 a share, it actually, within at some time in 2012, the stock went down to like $60 a share, so you would have lost a lot of money. Now, incidentally, Netflix went right back up to 300 in the 380s. Again, whether it's actually gone up or down, when you're watching this, it's going to be fluctuating even while I'm talking if the markets are open. But that's the downside and the upside of owning individual stock. You can hit that home run, but you're protected from that extraordinary amount of loss. And most people don't have that risk tolerance to take the ups and downs of the stock market. But to give you an idea, people want some decent rate of return. So in the United States, households own over about $10 trillion in mutual funds. And again, depending on the value of the stock market, it could be a little bit less, it could be more. But suffice it to say, a lot of wealth is concentrated in mutual funds. Now, to give you an idea, in 2013, Fidelity Investments, they had approximately $1.8 trillion under management. So that's just one single investment company owning, a ton of money in investments. So pension funds and life insurance. So what exactly are pension funds? So pension funds are mutual funds that hold assets for its members to provide retirement income. I am a part of one of the largest pension funds at least in the United States, perhaps the world as well. So two of the largest pension funds in the United States are CalSTRS and CalPERS. As a California state teacher, depending on, after 5 years, you're vested in the retirement system. So, when I take my retirement, whether I continue teaching in the public schools or not, I am vested because I've taught at least 5 years. Once you hit that 5 years, then your pension is going to grow. Well, California teachers actually opt out of Social Security, so they don't pay the 6.2% tax. Again, that number might go up as well. And rather, they pay into CalSTRS, 8%. Again, subject to change according to California law. So that money has gone in, and basically after 40, 50 years, what ends up happening is that when you retire, depending on your age, different factors, CalSTRS is going to calculate a formula and you get like a monthly pension. When I first got into teaching in 2002, there's a teacher that had been teaching at my school, Los Altos, had been teaching there for 30, 40 years. And, he got to the point where he had been teaching so long that he was actually losing money by teaching. So you couldn't really question his love for teaching, because had he retired, he would actually be making more in retirement than he was while he was teaching. So, pension funds can be fairly lucrative, particularly for the public sector. And again, one of the problems that really is going to have to be resolved one way or another is that there's tons of unfunded liabilities with the California pension system, because a lot of this money is promised, and it's great if you're a member, but the question is, how is that going to be funded? And again, it's a question that can take place by either raising taxes, lowering the benefits, a variety of ways. But to date, it has yet to be resolved. Another form of financial intermediary would be life insurance companies. What they do is they take in premiums from policyholders and make payments to beneficiaries upon death of insured. What is life insurance? I mean, it's simply that you're hoping, obviously, that you don't die, but if you do, in the case of a payable event, then your beneficiary gets paid that amount. There's different types of life insurance, obviously term, ROP term, universal whole. For the purpose of this class, it's not essential to know the different types of life insurance. I'm actually an insurance agent, so I have some experience in this field there. Life insurance companies, what they do is they pool together individual premiums, make various investments, and do their best to avoid making payouts. So they deny coverage to those that have high risk factors. They might raise the premiums, deny coverage. And one of the things that's kind of interesting is that a lot of people think that suicide actually is not covered under life insurance, which is actually, can be actually true or false. At least in the state of California, if suicide occurs after the initial 2-year period, day 1 of year 3, actually considered a mental illness, and it is covered under California state insurance law. But what these financial intermediaries do, they pool together money from various individuals, and what they do is they basically reduce risk for individuals. The reason why anyone buys life insurance or mutual funds rather than individual stocks or self-insuring is that they rely on these the financial intermediaries to basically pool together their money, and basically they allowed them to invest on your behalf. And that's basically what a complex financial system is going to do, rather than an individual trying to do everything by himself. It's just not going to work out. And maybe the biggest financial intermediary would be banks. So what do banks do? They accept funds from depositors. Okay, so banks keep only a fraction of the customer's deposits in the form of cash, sometimes more than others, depending on the time. So most deposits are lent out to businesses, home buyers, and other borrowers. So the idea of a Scrooge McDuck swimming in a vault of gold, because that's what individuals deposit, that's just not really something that happens. What ends up happening is that you deposit $100,000 into a bank. The bank has the right to deposit up to $90,000. Now, generally, it'll hold on to some excess reserves, but they're only required to keep 10% of that money. And that's how banks money. They make interest off of lending your deposits, right, which is a liability to the banks. So banks, what they do is they lend for long periods of time, but subject to the condition that its depositors could demand funds at any time. Now, again, that becomes a problem when everyone wants to withdraw all at once. But we have some systems designed just in case something like that were to occur. Now, if, for example, there was a bank run and the bank didn't do a good job, they run out of money, then with the Federal Deposit Insurance Corporation, the FDIC, they will insure up to $250,000 for each account you have. Now, it actually was originally $100,000, but the limit got increased to $250,000. So let's take a look at example number 1 here. So reducing which of the following is the task of a financial system? So let's break it down here. So reducing transaction costs, absolutely. Banks are going to try to reduce transaction costs. They definitely do that. So the goal of any financial system is to make it easier for lenders and borrowers to interact. Are they trying to reduce risk? Absolutely. People generally they don't like putting all their eggs in one basket. Spread it out. reducing liquidity. That's absolutely not. They want to increase liquidity. So it's not 1 only, it's not 2, it's not 3 only. It is 1 and 2 here. And it's not 1, 2, and 3. So the correct answer is D, 1 and 2 only. Banks try to reduce transaction costs and risk. Second example, which of the following is not a type of financial asset? Remember, these types of questions, go through and find the correct answer, find the financial assets, and then eliminate the one that is not a financial asset. So this one requires going through all of them. I mean, if you can quickly identify it, then that's fine, but try to eliminate the correct answer choices to find the one that's false. Loan-backed securities, absolutely. Bonds, that is a financial asset. IOUs. Bank deposits, they are different types of assets, definitely. Stocks, they are assets. A car is actually not going to be a financial asset. It is an asset, but it's not a particular, it's more of a physical asset. It's not a financial asset. So the correct answer is E, car. Okay, example number 3. Let's take a look at savings, national savings versus private savings here. The federal government is considered to be saving money when which of the following happens? So let's take a look. What does that mean for the government to be saving money? So let's look at the 3 different types of situations. So a government deficit is when the government's spending more, so clearly there's no savings going on. When there's a budget surplus, there's more revenue than there is expenses, so the difference would be savings, right? Budget balance would be when they're exactly equal. So it's going to be when there's a budget surplus. So let's take a look here. So there's a budget deficit. Again, that's going to be dissavings or negative savings for the government. There's a budget surplus. That's probably going to be the answer. I'll circle this tentatively. There's no budget surplus or deficit. That's incorrect, because there's going to be a budget surplus. Saving does not equal investment spending. That's a true statement. So saving does equal investment spending. So this is a false statement here. National savings equals private savings. So national savings equals private savings plus the budget balance. So if national savings, if that equals private savings, that's basically saying the same thing as C here. So C and E can't individually be the right answer because they're both saying the same thing. So that's wrong for sure. So the correct answer is B. There is a budget surplus, then there is savings in the national government. Okay, and the final example is if a nonprofit institution collects the savings of its members and invests those funds in the variety of assets so that it can provide retirement income to its members, it's called which of the following? Okay, so again, the key is nonprofit. It's a nonprofit institution. So mutual fund, these are for-profit companies, so you can eliminate mutual fund. Life insurance, again, they make a payout. Again, these are for-profit companies. A pension fund. A pension fund is going to be they're going to be accountable to the members. So STRS or CalPERS, they're a pension fund and they're accountable to the members. So their goal is to act as a mutual fund for its members, and they distribute according to certain statistical guidelines here. Credit union, they are nonprofit, but they're nonprofit banks. You could save up for retirement through a credit union, but that's not their overall purpose. And a bank, again, it's a for-profit institution. So again, these are good things to know. Again, directly on the AP exam, you might not see questions like this, but understanding how a financial system works is going to be something that is going to be a crucial building block as you learn some of the other stuff in this AP macro course. Thank you for watching educator.com.